love my job because I get to be involved in the markets, which are new and exciting every day. I love my job because I get to work with a dedicated group of professionals who are outstanding at what they do. I am Brian Allison. I am the Chief Investment Officer at Canada. I've been with Great-West Life for 26 years. I graduated with my MBA in 1988 and joined the firm that year. I have a Chartered Financial Analyst designation as well and have been in bonds most of my career. We are a conservative investor through and through, and we always do our own underwriting and due diligence. We never rely on anybody else, and I don't know what that tells you about us, but maybe we're, had bad childhoods or something, but we do not trust anyone. Great-West Lifeco is a large financial institution with operations in Canada, the United States, and Europe. We are managing over $500 billion of assets in those three regions. In the U.S., we have Putnam Investments and we have Great-West Life Financial, and that accounts for almost half of our assets. In Europe, we have Irish Life and Canada Life UK, and in Canada, we have three brands: the Great-West Life Assurance Company, London Life Insurance Company, and Canada Life Assurance Company. In Canada, Great-West Life manages more than $130 billion of assets. We manage segregated funds, mutual funds, and of course the general account. The participating life insurance account is part of the general fund assets. We have almost 500 people managing assets in Canada. They're located in Winnipeg, London, Ontario, and Toronto. We also maintain regional offices in Vancouver, Calgary, Edmonton, Winnipeg, Ottawa, Toronto, Montreal, and Halifax. And those offices manage real estate and mortgages in the local markets. The size and the scope of Great-West Lifeco's global operations allow us to capture the best practices from around the globe and apply them to the management of the participating account here in Canada. Let me talk about public bonds for a minute. Public bonds are issued in the public market. They carry a rating by one or more rating agency. The team is based in Winnipeg, and we manage about $27 billion in assets. When it comes to managing bonds, there's always a natural tension. And the natural tension is this: you've got people who are trading bonds, and traders love risk, and you've got credit people, and credit people hate risk. And so the two are set up that way so that no one party can make a decision. The traders can't go off and do something without having the credit guys who are sitting right there. They always have the ability to pull the brake and stop the traders. And again, that's done to make sure that the traders don't go off and start taking risk that we shouldn't be in. We have a highly disciplined credit risk management function, and again, we underwrite all of our own assets. And I'll give you another example. Again, we don't always get it right, but in 2007, Kaupting Bank, which is an Icelandic bank, they were rated A1 by Moody's at the time. They came to the Canadian public debt market with a $500 million issue. And our credit guys looked at it and expressed three concerns. Their three concerns were country risk. They really weren't comfortable with the Icelandic economy. Two, the funding model of Kaupting Bank. They relied very heavily on wholesale funding in the short-term market. And three was the growth strategy of the bank, where the bank was aggressively buying assets outside of the country. We decided that we would not participate in that transaction. Again, in hindsight, it was a brilliant call. That bank failed 18 months later, and lenders recovered less than 10 cents on the dollar. In the bond market, we operate in both public bonds and private placements. In the public bond market, there's two distinct teams. The first is the credit team. The credit team is responsible to follow each and every name that's in the portfolio, to follow it on a continuous basis, and to write it up on an annual basis. In this way, we have personal accountability, and we know that every asset that's in the portfolio is being followed closely. The second team is the portfolio management team. It's their job to trade the portfolio and ensure that the portfolio is positioned in a way that will optimize the return, as well as manage against the liabilities and preserve the liquidity that's required in this account. The company is a leading provider of private placement financing in Canada. We have a dedicated team located in Toronto, and we operate in three distinct segments. The first is lease finance, where we provide lending, we provide capital to small and mid-sized leasing companies, and we take security of the underlying equipment. The second segment is corporate credit. We offer financing to small companies that aren't able to access the public markets, or larger companies that want to retain confidentiality. Finally, we finance infrastructure projects. There's two areas here where we're active. The first is public-private partnerships, or P3s as they're commonly referred to. These would be typically government-related entities that are providing essential services, including roads, hospitals, and schools. We're also active in financing power projects. We've done a wide range of power project financing over the years and have included things such as wind, solar, and hydro. Private placements requires a bit of a specialized skill set in that it requires both credit skills as well as the ability to understand documentation and structures. One of the things that we do very well is combine those two skill sets, and that allows us to structure transactions in a way that is favorable to the lenders, preserving their rights. We buy bonds where we can do our underwriting, we can do our due diligence, and where we determine that it has an investment grade rating. We will not buy non-investment grade bonds. We stick to what we know best, which is investment grade credit. So we won't buy credits that are rated, that we determine are rated below investment grade. We also won't buy credits that we don't think are rated, even though they may carry an investment grade rating, that we don't like. And there are examples in the past that we haven't bought, despite investment grade ratings from the rating agencies, where our dedicated credit team have determined that they're not happy with the industry or the country or the sector that this company is playing in. The benefit of private placement lending is that we're able to get at the table and structure loans in a way that will protect us as creditors. The secondary benefit of private placements is that it adds diversification to the portfolio, and thirdly, we are compensated because it's illiquid investing. Commercial mortgages are properties that we finance right across the country. They offer us the ability to lend against a specific property, and we have a diversified portfolio, and there's four distinct asset types that we lend against. First is residential properties, multifamily primarily. The second is offices. These would be large office properties in major locations such as Toronto, Calgary, Vancouver, big well-known properties. The third is retail, again, primarily malls, strip malls, power centers, regional malls, super regional malls. These would be assets that are, again, well known, where you go to shop, where you buy your necessities, where you buy groceries or LCBO, and industrial properties. Our strategy is to have people in each of the markets, so we have people located in Vancouver, Calgary, Winnipeg, Toronto, Ottawa, Montreal, to make sure that we don't get caught, to make sure that we understand what's happening in the local market, and to have boots on the ground. Our strategy is always to be a conservative lender, and so we're looking for properties that have less than 70% loan to value, greater than 1.3 times debt service coverage, and we're always looking for amortization, typically in the neighborhood of 25 years or less. This portfolio is managed by a very seasoned team, and our track record in commercial mortgages is excellent. The overall portfolio is very high quality. If you looked at the portfolio quality today, our loan to value would be less than 50% and a debt service coverage of greater than 1.7 times with an A rating. So this is a very good asset class. It offers diversification away from bonds, and it provides a yield or spread benefit over public bonds. We have a portfolio of residential mortgages. These would be mortgages against your house, against my house. They're originated by our mortgage specialists, and these assets are diversified right across the country. They would be traditional loans that you and I take out. They have the benefit of offering us spread diversification over some of the other asset classes, as well as diversification benefits. The residential mortgages tend to be very short duration. Again, typically out to 5 years here in Canada. Our mortgage market tends to be shorter, so most people would have either floating rate mortgages, 1-year mortgages, or 5-year mortgages. So the short end of the portfolio would be covered by residential mortgages. The benefit of residential mortgages is that they have been a very stable asset class in Canada. We haven't had the same issues that the U.S. has faced, and so they've performed very well in the last cycle, and we expect they will continue to perform very well in the next cycle as well. So real estate, again, is another asset that we're actively involved in, and we have the benefit of having our own in-house managed real estate advisory company. Great-West Life Realty Advisors is one of the top 5 asset managers in the country, and they have offices right across the country so that we have local knowledge in each of the markets that we operate in. We also have the ability to operate in all of the asset classes, including office properties, residential properties, multifamily, and industrial. We can property manage those, we can acquire those assets, and we can even do development work. We have large clients, including the PAR account, but we also manage money for third parties, including pension funds and the segregated funds. The benefit of real estate in the participating account is that it provides diversification, but it's also part of the 20% equity that we use in the participating account to provide competitive returns over the long term and a hedge against inflation. Common stock is in the participating account in conjunction with real estate, and combined those two asset classes make up 20% of the participating account. We do that because it provides the ability to offer a competitive long-term rate of return, and it provides a hedge against inflation. The common stock is managed by GLC Asset Management, and that's our in-house asset management company, and we have three distinct teams. Great-West Life Investment Management, based in Winnipeg, London Capital Management, based in London, and Laketon Investment Management, based in Toronto. Three distinct teams with different styles, but we have the ability to offer all of that to the participating account in both dividend and growth mandates. The benefit of the portfolio, the way it's structured, is that it's very balanced and diversified. You have almost equal weightings in government bonds, corporate securities, mortgages, and equities, and that provides stability over the long term. We manage from a position of strength. We're not a hedge fund. We're not making big bets. We're not going to risk the company on where I think interest rates are going or some crazy call like that. We're going to continue hitting for singles, and we're going to do it the same way we have been doing it, by trusting no one but ourselves and maintaining a disciplined approach. The objective of the participating account is twofold. One is security, and second is participation. Security is first and foremost, and that's the most important objective. We are looking to match our cash flows against the liabilities, so we select assets that match the liability profile of the account. Second thing we're trying to do is maintain adequate liquidity. We need to maintain the liquidity in the account so that we can handle anything and everything that comes at the account, including requests for policy loans. And the third thing is that we need to maintain sufficient surplus in the account, again, so that if there's an event in the market, we can handle it and not have any impact on the account. Our portfolio tends to be very high quality because we're first and foremost concerned with security, return of capital rather return on capital. The second objective of the participating account is participation. We're looking to do four things in participation. First, we want to provide long-term rates of return that are competitive. Second, we want to provide stable returns over the long term. The third thing we want to do is we want to participate in economic growth. And the fourth thing that we want to do is provide a hedge against inflation. The investment policy of the participating account really covers all of the major items that you'd expect in an investment policy. First is asset mix, so we maintain asset mix requirements within the participating account, ranges for each of the asset classes. The second thing is liquidity, where we're looking to maintain liquidity to cover expected and unexpected events within the account. We also have credit quality requirements, and by that I mean we always acquire investment-grade assets. We do our own underwriting. We make sure that we understand the assets, and we acquire only the best assets for the participating account. We never rely on outside sources for our due diligence. The strategy for the participating account doesn't change much over time. It's a disciplined and consistent approach to all of the markets. On the fixed income side, there's really three objectives that we're looking for. One, a continued focus on originating high-quality mortgages and private placements, to maintain a disciplined credit process, and to actively manage the public bond portfolio to take advantage of opportunities. And I can't overstress those first 2 points. It's absolutely fundamental that we have to maintain our disciplines. More money has been lost chasing yield than any other strategy, and we can't allow ourselves to get into that. I always tell the team, the worst loans are made in the best times, so make sure that we stick to our disciplines. The strategy for the equities and real estate is to maintain a 20% weighting in the participating account. Currently, we'd like to increase the weighting of real estate, but we're only going to do that when good opportunities arise. The goal of the participating account is to make sure that this account can handle the next downturn. This portfolio performed extremely well during the last crisis, and it's our goal to make sure that that happens again when the next crisis hits. We have a long history in participating life insurance, and we take a long-term view when managing the assets. We manage for security, so we have a priority on originating high-quality assets. We manage from a position of strength. We have a diversified portfolio and a history of proven results, and we manage with in-house expertise. We have professional managers in all of the asset classes, and we believe that we can deliver better results by doing it ourselves and doing it right. We are committed to honoring the long-term promises we've made to participating policyholders. Our team of investment professionals is second to none, so we can bring you the results that deliver outstanding results to your clients.